Hello, everybody, and welcome to our webinar on PUMa tax. My name is Allison Grant-Lunes. I am the owner of the relocation agency Your Transformation. I have been helping people move to France for a little over 10 years, and our agency helps people to get the right visa and do all of the right admin for following your dream of living in France and for making sure that your life in France is sustainable in the long term. And part of that means making sure that you understand what taxes and financial planning situations you're going to have to do. So we work with lots of different professionals to complement the resources and information that we are able to provide. And today we are going to be covering this PUMa tax with Isaac Bakshisha of Monceau CPA, who is our accountant and who works with many of our clients. He is a CPA and expert comptable, so certified in the US, France, and Canada, and helps many of our clients with their international tax situations. So PUMa tax, PUMa, if you're not aware, is Protection Universelle Maladie. So this is the insurance premium or cotisation for French healthcare when you reside in France and become eligible for the healthcare system after living here for 3 months. We register all of our clients for this. You can't really opt out, hence the universal aspect. And Isaac is going to present PUMa and the tax or the premium that gets you into the healthcare system in France if you're not paying in on the basis of your salary. So I'm going to go ahead and let Isaac take it away with his presentation. We've got the pre-submitted questions at the end, and if there are any other questions that come up during the presentation, I will ask them for you guys if there's enough time at the end. So feel free to put additional questions in the chat, and hopefully we will be able to get to them all. So without further ado, I'm going to give you Isaac, and I'm looking forward to learning more as well from this very informative presentation.
Thank you, Alison. Thank you, everyone, for joining us this afternoon or this morning with this great presentation about PUMa. PUMa is indeed complex concept to understand. We'll walk through everything. And with no further ado, I will start by obviously telling you about what's on the menu today. What are we going to cover? So obviously, we're going to talk about what is the PUMa tax, who must pay the PUMa tax, how is it calculated? Complex, but it's important to understand. We'll go through different examples and we'll tell you the technicalities on when and how and the exemption, how to avoid it. And obviously, will tell us more about us and our services. But with no further ado, I'll allow myself to introduce my pedigree or my CV or my resume to you guys. I am indeed a French guy, but also US and Canadian citizen, licensed in all of those three countries. And as you've seen, I have years of experience dealing with international clients, mainly from the US and Canada, but not only. Hopefully, I will try to present you a pure French topic with an American approach so you better understand what are you facing, what are you will be dealing if you are or will be in France with the PUMa tax. So the first thing we need to understand, how on earth was this PUMa tax enacted and what for and what's the history behind it? So, as Alison pointed out, the Protection Universelle Maladie PUMa tax came through the Contribution Subsidiaire Maladie, CSM, fancy word to say the same thing. So sometimes you'll hear PUMa, sometimes you'll hear CSM. It means exactly the same thing. What it means for us Americans, it means it's just another tax, another fat cat tax, because it's here to say, hey, you are in France, the cost of healthcare is really expensive, and everyone in France appreciate being fully covered and being able to get an MRI, an X-ray whenever they want with no limitation or pre-existing conditions and so on that we have in the US. But all of that has a cost, and that cost is how everyone in France should be participating into the healthcare coverage. So it is often remembered as a high investment income or rentier income because for those that are not necessarily working and not contributing by default, the PUMa tax has been there for that complement. The good news is whether you are working or not, Whether you have intention to be here for long term, no need to have a private health insurance because after 3 consecutive months of being in France, and since 2016, everyone is allowed to receive healthcare benefits for free. So it's very important that you understand that there's no matter what, there's a cost. And sometimes the cost we look at it, the PUMa is not that high compared to a private health insurance. But no matter what, you will be covered through Social Security. You just have to walk into your local Social Security agency and request access to the carte verte, famous health card. But the going back to our topic here, PUMA tax is, as I said, whether you contribute or not. So everyone, directly or indirectly, everyone has to participate in the global effort, the universal effort to the cost of Social Security. The good news is for Americans, many, many years, we didn't know if that tax was deductible as part of the foreign income tax in the US. And it has been ruled that the CSM, PUMA tax, is also considered to be one of the foreign tax that you would have a tax credit in the US for. So that's also important to understand. You're not paying a tax for nothing in France if you are indeed eligible to pay the PUMA tax and will be getting a healthcare coverage for it, but you will also get a tax credit for it from the US side. Now, who must pay the PUMA tax? Okay. So there are 3 consecutive criteria. We have already talked and assessed that no matter what in France, you have access to the Social Security, okay, for free. Doesn't matter how much you make. We've already assessed, and we'll go more into it, that if you work, obviously through your job, or through your pension, you are contributing somehow to the Social Security. So the question is, what happened to the other ones? The ones that came from America, from Florida, from California at the age of 50, 60, or 70 to retire in France, have never worked in France, or are not working, or are not collecting any pensions or any revenue from France. What's happening? Where am I standing in terms of PUMA tax? So in order for you to be in the scope of the PUMA tax, you have to meet all of those consecutive 3 criteria. And very critical to understand that is one of the most important slide of the presentation. If you meet all of those 3 criteria, you will get within scope of the PUMA tax. If you do not meet one of those 3 criteria, you're out of scope, hence you're not paying any PUMA tax. So let's talk about criteria number 1. Well, that obviously if you reside in France as a tax resident, and we'll determine in a minute what does it mean to be tax resident in France, you are indeed meeting criteria number 1. And when we talk about tax resident, people get it always wrong. It's not about the number of days, and I'll talk in a minute about that. It could be just when do you meet the rule, the criteria of tax residency. So some people arrived December 25th for Christmas to celebrate in France and settle in France. From that date onward through December 31st, they are tax resident of France. So it does have consequences. Criteria number 1. Criteria number 2, you do not work. And if you do not work, you do not generate any revenues. So if you do not work to a certain level, we'll see, then you do not generate any French revenue, then you are within scope. Okay, in order, as we said earlier, to be exonerated from the PUMA tax, you have to work and meet a certain criteria and certain level of revenue. If you don't work enough or don't work at all, you are within scope. The third is if you have passive income. And passive income, as you can see there, rental income, dividends, and capital gains, and so on, above a certain threshold, then hence the same story will apply to you, which is you will be into scope. Let's dig into one of each criteria to understand what it means. So fiscal residence is always one of my favorite topic because my fellow Americans always get it wrong. The question is not here, hey, I've spent 100 days in France, it's enough, that's it, I'm not a French tax resident. No, it's not at all right. It's one of those criteria, and that's what we call it alternative criteria. But one thing above and beyond everything, if you requested through Allison to get a visa to France, what does that mean? That means you are voluntarily electing to be a French tax resident because either you're going to spend the majority of the days in France or because you've elected France to be your main place of abode, because your kids are going to school here, because you're working from France. And don't tell me that you're working for a US company. You are working from France. You are physically sitting in France on Zoom, on a computer, on the phone. So you are working from France. So if you meet one of those criteria, you are becoming a tax resident even on December 31st. Obviously, that will be your date of reference. Anything before that, we will not care, but anything beyond that date will be considered to be French tax subject. The second point we talked about is revenue stream. So we said that if you have an employment contract or if you have a micro enterprise, you are considered to make enough revenues, hence contributing to the healthcare system, hence not subject to the PUMa tax, so long as you meet one of those two criteria. The first one is if you get a pay stub every month on an annual basis, you made more than 9,273 euros and 60 cents. And obviously, those numbers vary year after year depending on what we call the PASS, PASS. This is a reference number given to us by the French Social Security. Then you are considered to have made enough money. And if you've made enough money, you've contributed to Social Security, you're out of the PUMA tax. The second example is the micro enterprise. A lot of people tell me, hey, I've made more than 10,000 euros, so I'm good. No, no, no. You have to make more than 18,547. What does that mean? It means basically twice the amount, 9,273 euros and 60 cents. Why? Because if you do take care of your French tax return, obviously with Monceau CPA, you will understand that micro enterprise, you get a 50% allowance. 50% of your micro enterprise revenue is completely neutralized. So in order for you to make above the threshold, you have to make at least 18,000 euros in order to meet that threshold. So those are the definition of revenue stream, criteria number two. Criteria number three is passive income. So what do we consider passive income? Passive income is property income, dividends, sale of a property, sales of any stock that you have in the US, non-professional profits, or we call that BIC or BNC in France. Basically, any income that you generate without necessarily having to work for it, which is employment more often, to above a certain threshold, usually about 24,000 euros a year, you will be subject to the criteria number three, right? Remember, all of those three criteria have to be met in order for you to be in scope of the PUMA tax. We've talked about criteria number one, criteria number two, and number three. If you do not meet any of them, then you're out of the scope. If you meet all three, you are in scope. So it's very important to give an example. If John Smith comes to France on August 1st with his wife and he got a long stay visa in France, he becomes a French tax resident automatically on August 1st because he has a nice house in Toulouse. And he's retired. His wife has a micro enterprise, but she does 12,000 euros of revenues a year. So obviously below the 18,000 minimum. And he gets dividends from back home from the States of 40,000 euros a year, then he will be in the PUMA tax scope. And the penalty of being in PUMA tax, it's assessed by person. So that means he and his spouse will both get a PUMA tax bill at year end. And we'll talk about it. The opposite is also correct or incorrect, you might say. If one of the spouse meet the criteria of the exemption of the PUMA tax, he or she protects the entire home. So if I'm working with a CDI in employment and I get more than 10,000 euros of pay stub on a yearly basis, and my wife does not work or collect, pass US and so on and so on, she will not be exposed to the PUMA tax because I'm protecting my household. Now, let's talk about the complex question, how technically it's calculated. So I try here to give some example But again, it's kind of complex, but we'll try to go for it. Now, remember, we talked about three criteria: French tax resident, having no employment revenue, and having passive income. Well, it's simple. If your passive income is more than 23,184 euros a year, then anything below is no PUMa tax. We just talked about the criteria. It's one of the criteria. So the passive income threshold is 23,184. Same thing applies if you're making a lot of money, 370 euros, 1,944, which is 8 times the reference number of the past. There's no more PUMa tax. The PUMa tax will be calculated within that threshold, nothing beyond that. And to understand it, 6.5% is the exact amount that you will pay of your revenue. So let's talk about our good friend, Mr. Smith, that came to France, opened a company, and collected 120,000 euros of dividends from France or from the US. In this case, we've decided to put it as a SASU, which is a typical S Corp, C Corp, or LLC that you will have in the US. And he also earns just 2,500 euros of regular employment income. No luck for Mr. Smith because his professional activity, the 120,000 euros of dividends, is a lot of money. But at the same time, his professional activity of the 2,500 euros is less than the past, which we talked about, 9,000 euros and some change. So what does that mean in terms of computation? Well, let's look at the computation. We talked about the fixed rate. We talked about the more than 370,000 euros earned. And you can see here the contribution amount, 6.5% times A, blah, 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 blah. So we've given you here the letter A, the letter pass, the R, so at least you see the computation and how things are done. In our case of Mr. Smith, it's 6.5% times, well, 120,000 euros that he's made as of, we give him half of 50% of this amount as an allowance times the pass, which is the Social Security reference number, times 1 minus how much is made in terms of employment. If he had made zero, it would have been zero, divided by 20%, times the threshold for the passive income of 23,184, which is 45.96. A lot of people don't get it, and that's why we here have created a simulator. We'll talk in a minute in the simulator, but at least I wanted you to understand the technicality, what's behind the numbers, so you understand clearly here what are we dealing with. Unfortunately, Mr. Smith here has to deal with the PUMa tax. So concretely speaking, a lot of clients come to me and say, Isaac, I don't know how much I'm going to make. I might sell my stocks, but I want to be below the threshold. Don't you have a way for me to understand how much PUMa tax we have to deal with? Well, if they're client of ours, we usually give them the simulators. If they're not client of ours, you can get the simulator if you follow this rule. So first of all, let me show you the simulator. It's an Excel spreadsheet where you can see here on the bottom, the top part, we put the revenues, whether you have different company structure in France, you can put it here, everything. So that comes from your professional income bucket. Then you have other criteria that you see here. Then you have all of the other income, which can come from anywhere in the world, right? We talked about property income, capital gains, and so on and so on. And that gives you, at the end of the day, how much PUMa tax you will face. So as a token of my appreciation, I said to Allison, which I usually sell this a spreadsheet for non-clients, but for working together, I'm sure you will so much appreciate the great presentation we have today, and you have the QR code there. As soon as I see a great, nice review, I will share with you the simulator so that you can play around the numbers and do not have headaches with the great computation of getting the PUMa tax. Enough said now with what's the PUMa tax, how it's calculated, and what are the criteria to determine the PUMa tax. Let's say you're now Mr. Smith, you know you have to pay PUMa tax. Okay, it's unfortunate or not, because compared to private US health insurance, the number we just talked about for Mr. Smith was just 4,500 euros on a yearly basis, which is definitely less than an annual premium for a great health insurance coverage coming from the US. So now you decided that, okay, you are within scope, when and how to pay my PUMa tax. So, as you know now, for the last few years, everything in France has been generated off the annual tax return. The tax return cycle in France is usually late May, early June, depending on where you live. If you reside in Paris area, for example, the deadlines are usually around June 6, 7, or 8. The official dates for this year have not been published yet, but those are the dates usual year after year. So if you do your French income tax return, you put in there everything you've earned, whether in France or outside of France. As you know, as French tax resident, you have to declare and report your worldwide income. Then over the summer, the tax authorities are computing your tax bill and send you what they call the avis d'imposition, which is the tax bill, which is automatically transferred to the URSSAF. The URSSAF is the social body in charge of social charges contributions. So you will get by latest last business day of November a bill, a letter from the URSSAF telling you you are subject to PUMa tax and you have until Christmas to pay it. You can pay it multiple ways. As you can see here, you will have to open a portal for you online. That portal will be a great way to either make a claim, complain, make a negotiation to pay over installments. And those figures and the access codes will be given to you through the first time letter you will receive from the URSSAF. So it's very important to keep the letters ahead of the game. You log on, create an access to the portal, and communicate with yourself to pay the PUMa tax in any way you have. And I highly recommend you to keep a proof of the payment in order to ensure that you are up to date with your obligations. Now, let's say I want to be exempted because I feel I can be exempted, or I want to avoid paying the PUMa tax, or I believe my accountant or myself, I made a mistake when I declare the tax return. I need to make a valid claim to the PUMa tax authorities, which are known as the URSSAF. Well, let's talk about avoiding the PUMa tax. Well, one can avoid facing PUMa tax by the following cases. For example, if you do get a pension from the France or from the European Union, you will be exonerated from the CSM. If you do get a pension from anywhere else in the world, it will not exonerate you. If you are unemployed in France, you will be exonerated. If you have a pension of disability, you will be exonerated. If you're a student or a dependent of a working spouse, we spoke about it earlier. If your spouse is working, then you're covered. It covers the entire household. Or simply, if you do not meet one of the consecutive criteria. Remember, we had 3 criteria earlier today. Or if you do get a salary, make sure you get a salary more than 9,273 euros and 60 cents. At last, and we talked about it also earlier, if you have the capacity to modulate how much you are distributing capital gains, for example, how much stocks I'm going to sell this year, make sure you sell less than 23,184 euros net for the year 2024. So you see, there are ways to modulate through the PUMa tax. Now remember, it's not because you pay the PUMa tax that you will get access to Social Security. You will anyway, as I said, since January 1st, 2016, have access to Social Security, and you will anyway be facing PUMa tax whether you've asked for Social Security. A lot of my clients say, hey, I don't need Social Security in France. Well, you can't decide. That's the way it is. Okay, maybe you have not been caught yet, but the French system will at some point come back to you and say, hey, pay the PUMa tax. Either way, everything goes through the tax return that you're submitting. The next topics we talked about is if you have difficulties, you're going through a difficult time, you can ask and negotiate with the URSSAF to move things around, have some installments or spread over the next 12 months the amount due. Because we talked about it also, it could be a high of a number if you're making a lot of money or if you have a high capital gains. Let's assume you sell your home in the US with a capital gains of $500,000. We know that if you married, $500,000 is exonerated as a home exclusion exemption in the US. But in France, you will not be taxed on it. But PUMa tax will consider that income for the purpose of CSM computation. So you really have to navigate through and anticipate through things around before you do any operation. That is also one of the reasons I tell my clients whenever you make a big move to France, make sure you can sell your primary residence before you move to France. Because once you move to France, even though we know you have 12 months grace period to be not facing any taxation on the capital gains, but the PUMA tax is around the corner. And obviously, it's complicated. Now, I got to admit that sometimes with non-French returns, the URSSAF and PUMA tax are making sometimes mistakes to the benefit of American clients, but it's very rare and it's very occasional because even if you are not in scope and you should have been in scope in the year 2023, they'll come back at some point in 24 or 25 or 26. So they're still aligning with non-French income because that's not by nature the typical type of population they will have to deal with. And they have been, and since many political embryo in the US, many Americans coming to France. And that those are the questions that yourself are getting better and better at. The claim is if you believe they've made a mistake or they haven't gotten the right numbers, which also happens a lot of the time. If you don't file your tax returns in France, the tax authorities or your staff will just assume based on the highest number, which is definitely not to your benefit. So you should never be filing late or should never just not file. And if you have not filed, then you should correct and talk to them and make sure that they fix it. And if the number is not properly calculated, not thinks you have our great presentation and the way the computation is done, you can always fight them, and this can go all the way to court. Well, as we almost wrap up, I want to talk more about what we do and what we offer in terms of services. Those are a picture of the services we provide. Obviously, we provide mainly the assistance with personal income tax returns in France or in the US or any other countries. But we also assist you with Alison and her great team all along your installation, your setup in France to set up a company, translate documents, and so on and so on. So we usually, the people to go to in order to have the right answer or at least the right contact. So feel free if you have any questions. We offer free consultation as well. If you need to come back to this great PUMA tax, but either way, you're going to come back to the PUMA tax because I know you want the great simulator, and I'm sure you've already done the Google review, or you will, in order to get it and claim it for free. The next things is the questions that were addressed to us prior to this presentation. But if you have any other question, Alison will tell me those, and then hopefully we'll tackle those down as well. So those are the questions that were given to us before. Let's talk about them together. So I'm moving to France from the US for my spouse. Congratulations and welcome to France. I plan on continuing my professional activity in France with the correct visa. However, my spouse will be unemployed. How does the CSM tax couple with only one income? I love those questions because after we've seen the presentation together, I'm sure everyone can now understand and address this question by just simply quoting the presentation we had, where I clearly stated that if one spouse of the family works and contributes to the Social Security, then he or she protects the entire family and the entire household of the PUMA tax. PUMA tax, remember the historical origin of it, has been enacted because some people were in a gap, in a black zone, right? Where you're not working, you're retired, but you're not retired from France. You are or supposed to get French Social Security in France, but you're not physically or financially contributing to it. Let's make you contribute for it, so long as you meet the famous three criteria. So to this first question, if one works and the other one doesn't, the entire family is protected. Second question. My wife and I are buying a small house in the share and hope to spend several months a year in France. If we're living in France part-time, that what will be our liability for social contribution taxes? Well, many questions in one question. First of all, we talked about also the notion of tax residency. Obviously, if you have a visa, things are more obvious. But if you don't have a visa and you spend the majority of the days in France, then you will be a French tax resident. But let's take a concrete example. Mrs. and Mr. Smith, they love to travel. They are in the late 60s and they travel all around the world. They spend 60 days in the US, 60 days in Brazil, 60 days in Africa, and the remaining 180 or the remaining 150, which is below the 183 days in France. Well, they will claim, hey, I spent less than 183 days in France, so I'm not a tax resident of France. Well, France will say, hey, France is the country in which you spent the majority of the days out of the calendar year. So according to us, you are a French tax resident. So you really have to make sure of that criteria. But to this question, assuming that you are not a French tax resident, then you have zero social contributions whatsoever. Now, to your point and go beyond, if the house you're buying in the share is just for your own use, then no social contribution whatsoever. If, however, you start renting the place, then it's a different story. But based on what you describe here, you will not have any social security to face. As an American resident in France, will I owe PUMa tax on US retirement income? Well, let me finish the question. For 1K IRA Social Security, I have no other income. I have not seen any definitive statements anywhere that answers that question. Well, lucky you, Mr. or Mrs. Third question. We will hopefully address that question today once for all. Well, let's talk about the three criteria. Are you a French tax resident? Yes, because you said as an American resident in France. Are you working? Well, it looks like you said you have no employment income in France. So you are meeting criteria number two. Number three, are you making passive income? Well, did we earlier define what is passive income? Yes, we talked about sale of a house, sale of stocks, dividends. Social Security, IRA, and 401k belongs all to the big P family, the pension family. Even they are not French pension money, it's still a pension source. It's not considered to be passive income. If it's not considered passive income, you are then not meeting criteria number three, in which we stated that passive income beyond 23,184 earned even outside of France will make you meet criteria number three. And lucky you, because you've already met criteria number one and two, but you're not meeting criteria number three. If you're not meeting criteria number three, you're out of scope. And you could still go to the local Social Security and have access to your Social Security. I believe PUMa considers, question number four, I believe PUMa considers the ordinary dividends and cash money market funds in my US taxable brokerage account as part of my worldwide income. I want to say, duh, we just talked about it. But if I hold cash in a tax-free money market fund, is that still counted in the total of my worldwide income? Well, is that still considered to be a passive income? According to me, yes. The fact that the US, for that specific account, treated you as a tax-free does not make the income to be passive or non-passive. It is still passive income and still meeting the definition of the PUMa tax as you stated earlier. So unfortunately for you, whether it's a tax free or not, you will be subject to PUMa tax. But the good news is you will not be subject to any tax in France because the tax treaty between France and the US will recognize what the US is telling you, so you will not be taxed twice. Question number five. A married couple, US citizens with tax residency in France, okay. Assuming no income in France, okay, we'll talk about that. Criteria number two, no income. But letter B, selling shares in the US during a long-term capital gain of 500K. Well, I've kind of envisioned your question because I did talk about it earlier that any capital income more than 23,184 will trigger a PUMa tax so long as you meet criteria number one and number two, which you seem to meet. Looks like this scenario will trigger the maximal PUMa contribution of about 45K. Well, you got it right, except that the pass, which is 22,500, probably you got the number from 23 and not 24, but it's about right. Can those 45 PUMA be credited against the 75 long-term capital gain tax? Whoa, 15% in the US. Bottom line, how much tax would the okay? Well, you're making a lot of shortcuts, Mrs. or Mr. Questions number five, but you will be, and you I think recognizing you will be subject to your PUMA tax in France. Good news or bad news, you are. And you know, based on my presentation, that the IRS has recognized the PUMA tax as a foreign income tax, Form 1116, and that tax credit will be used against any income liability generated of the US. So it's not dollar to dollar, which is one you're spending the PUMA tax will offset whatever tax, capital gains tax I have in the US. But on a global note, it will definitely neutralize once the income liability is generated in the US versus how much tax credit you have against it. Hopefully, you've understood me. Question number six. I'm an American French dual citizen, so am I. And my wife and I retired to France a little over a year ago. Well, again, congratulations. I'm 60 years old and she's younger. I've never worked in France. Okay. An American friend of mine who's relocating here told me that because he worked 1 year in France with me and will get a French tiny pension, says he will not be subject to PUMA. Is that true? Yes, sir. If you are getting a French or EU, European Union pension, whichever amount you're getting, you are exonerated from PUMA tax. Lucky him for your friend. So if I get a job for a brief time and my employer pays social charge on behalf, would that eliminate my charges? We talked about it. If you do work in France as an employee and make more than 9,200 and some change on an annual basis, you do not pay PUMA tax. If you do have a micro enterprise, and you make more than 18,500 and some change on an annual basis, you will not be subject to any PUMA tax in France. Alison, I think the stage is yours. It's 3:42. Hopefully, I've met my deadlines in terms of timing. Maybe there are other questions that you want me to fill in for the next few minutes, and I hope everything was clear so far.
Great. Yeah, that was really informative. We do have a couple more questions in the chat. I think there are variations on things that we talked about that we're just going to confirm. Okay, so I just want to touch briefly on before we get into the questions about the process of registering for PUMA. So registering for healthcare, this is separate from actually filing to pay the tax. You can register for the French healthcare system after 90 days when you're in France with a visa and you're not working. You're not going to just show up to the Social Security office. You're going to mail in your application, and we need to make sure that you have all of the correct documents way in advance so that you don't, your application doesn't get rejected because you don't have like the correct birth certificate and things like that. But that's totally separate from actually making your URSAF account and paying your PUMA tax.
If I may, Alison, just to make sure I understood clearly. Yes, when you arrive in France and you've been here more than 3 months consecutive, 90 days, you can request whether you walk in or email out your request. Alison will help you out, but you are entitled to have Social Security coverage. Okay? Trust me, it never goes right the first time. There's always complication. Make sure you have all the documents original sworn translated with sworn in translator. I could help you out with that. Make sure everything is in order, but that's one thing no matter what. The PUMA tax comes after the first year of French income tax returns submitted. It will automatically come to you directly, supposedly. And that's when you will get a letter and create a URSAF for the purpose of PUMA tax account. Because URSAF is a big social charge body in French institution that you will deal when you deal with micro enterprise, that you will deal with when you do pay stubs and many other hats. So make sure you don't get yourself confused when we talk about yourself for the purpose here of PUMA tax.
Yeah, and so there was a question about like age factoring into the healthcare system. It doesn't. There's no such thing as a pre-existing condition in France. Any type of preventative healthcare that your doctor prescribes is going to be covered. So we're not looking at this from a US perspective of how much does it cost. We're looking at the whole point behind Protection Universelle, universal protection, is that everybody is covered for any particular illness or treatment that they may need. So we're not looking at it from a US like profit-based perspective. And I just want to point out too that even though you can start the process of registering for the healthcare after 3 months, it's not going to be done immediately. It's going to take a couple months before it kicks in and you actually have paperwork proof. So, hence, certain visa types, you're required to get a temporary policy. Theoretically, everybody should be covered by some other catastrophic coverage policy until they get into the French system, which that's a different webinar. But to get back into the questions that are directly related to the tax, Cecile asks, if you live and work in France remotely for a company in the US and not with any French clients, are you still responsible for paying the social charges? My favorite question.
Well, it's a webinar by itself, Cecile, if I may say, because first of all, there's no such a thing as working remotely and no paying taxes or not being subject to the legislation or the tax code you live in the country you live in. So it's a cliche that many Americans, but not only have in the head, that France works on the notion of territoriality when it comes to tax. So if your butt, pardon my French, is in France and you're working here, you're not working from the US, you're working from France. Hence, your activity must be subject to French tax and it must be registered. So that's one thing per se that you need to figure it out, and we can talk about it if you need a consultation. But that you will be in France working remotely under the right setup in France, whether a company or a pay stub or micro enterprise, then it goes back to the main questions. If you go above the threshold of working, then you will be by default contributing to the system. Hence, no need to PUMa tax. If you are below the threshold, you will face PUMa tax.
And if you're doing something that you're not supposed to be doing, like working remotely on a W-2 with a company not registered in France and you're on a visitor visa and the government doesn't know that you're not properly registered to pay social taxes, you're probably going to end up being double taxed.
So let
That
me
would be
tell
the
you,
least.
Alison, what's happening. First of all, you should pray to God not to get caught. That's the first thing. Second thing is, yes, you're right to say. People don't get it, but let's put it this way. You are first contributing to the US healthcare system while you don't reside there. So it's just money to the waste. Okay. So that's the first thing. When you pay W-2, you have all the social charges for in a country or in a services that you will not get to. Because even if you do get to the doctor here, your US medical coverage will never cover because you were supposed to be in the US and you informed them that you were working from abroad. So that's one thing. Second thing, yes, France might tell you and wake up one day, say, hey, you should have been paying taxes in France. And as Alison pointed out, say, hey, I don't care about what you did wrongfully in the US, you should pay taxes in France. But you're going to claim, hey, but there's a great French tax treaty between France-US tax treaty that Isaac talked about it, that is indeed one of the most generous treaty out of all the treaties. But the treaty tells you that you're either here or you're there. You cannot be two places at the same time. Otherwise, you just have to tell me how you do it. But that's the rule. And at the end of the day, if you intend to stay here long term, whether for visa purposes, for family purposes, or for financial purposes, you really need to get your situation, not to say something else, straight in order to make the right decisions here.
Okay, we are a couple. My wife has a micro-entreprise and earned $15,000, let's call it euros, and I'm an unpaid collaborateur. She earned more than the 9,000 whatever euros, so she is covered and therefore I should be covered as well.
Correct. As a married or paxed couple, if one of the member of the family is indeed contributing, he or she protects the entire family.
I just want to point out though that 15,000 is under the micro-entrepreneur threshold.
Correct. So remember the threshold we talked about. I could still show them here, so at least everybody knows. For the micro enterprise, we talked earlier that the threshold is 18,547, which represents twice the 9,273 euros and 60 cent threshold. So make sure, Mr. Holger, that you're making more than 18,000 euros and not in dollars in France through your micro enterprise to make sure that you and your family are kind of PUMa tax free of PUMa tax.
Okay. And then there's a question as well about if I get my PUMA charges back as a US tax credit, why should I care about the PUMA charges?
Well, first of all, you do not look. First of all, question is right and wrong. First, let's look at country by country. In France, you're in France, you pay a PUMa tax because you are nowhere in any situation to contribute to the healthcare system. So France has determined that based on your situation, you have to pay such amount of taxes in France. The US considers to be this PUMa tax as a regular tax, one of many other taxes we have in France. So yes, that taxes in the US is considered to be foreign income tax that will give you a tax credit to reduce your US liability. Don't forget that a foreign income tax credit is not refundable. That means if you have tax liability in the US, it will get reduced through that PUMa tax. But if you don't have any US liability, like many of my clients, because we optimize their situation in order for them not to pay taxes in the US, then there is no tax credit to go against it.
And I'm just going to extrapolate on this question and another one that I see here a little bit and say, let's say we're in the situation of somebody sold their former residence in the US, they have a big capital gain, so they're not going to pay income tax on that in France, but they're going to pay PUMA tax on that capital gain. The US, in my understanding, would still fully tax the capital gain, whatever the taxable capital gain is, and they're not going to give you a credit for like against the US capital gains tax that you would pay for PUMA tax in France, or am I misunderstanding that?
So let's put it this way. Mr. and Mrs. Smith have left the US and generated capital gains of their home, primary residence in the US. If they are within $500,000 of capital gains, they are paying zero tax in the US because that's the home exclusion tax credit. France will recognize that as well, which is you will not pay any taxes in France on the sale of your home, but you will pay the PUMA tax. You will get a tax credit in the US. But if you have nothing against it to write it off from, then it's just a simple credit that will go to its loss, right? If, however, they are selling Mr. and Mrs. Smith a rental property they had, so they will no longer have a home exclusion exemption in the US, hence they will pay taxes in the US. That PUMA tax income, PUMA tax paid in France will come back to the US as a tax credit to reduce their income tax liability in the US.
And then one more question, I think. Are passive activities such as rental property income based on gross receipts or net expenses? Net.
Net, it's always the net.
All right. Well,
Alison, before I conclude or you conclude, I just want to remind everyone, I'm just going to present it here as well. This simulator, if you want it, you have the QR code. Maybe you will share the presentation later, whoever needs it, you can just email me. You have there my email address presented on your screen. And if you want to create this simulator, you know what you need to be doing. And if you need a free consultation, you can always come to us and we'll obviously help you out about it. I think somebody is asking, Wendy is asking a question. I want to address, make sure she's reminding us. Is the tax recalculated each year? Example, in 2025, receive a large capital gain in 2026 below the threshold. What I pay in 2027? That's correct, Wendy. It's an annual tax. So if you are in scope in 2025 and not in 2026, or vice versa, you will basically look at it on an annual basis, and every year is different. I think I hope we've covered all the questions. If anyone has any other questions, now will be the time. Otherwise, you know where to reach out to Alison or myself now that you've seen my email presented on the screen. And I will be delighted to help you out and address any questions that you have in the future.
great. Well, thanks so much for joining me, and thanks to everyone for coming. That was really helpful and informative. So, in terms of our upcoming events, our next Q&A on moving to France is on Monday, April 7th at 7 p.m. France time. I believe that's the next webinar type event that we're going to be doing. Then Isaac and I are going to be doing another presentation on French taxes for Americans in France on Tuesday, April 8th. We're going to also have a workshop on assembling documents and completing a checklist for loved ones, family members with important documentation. So, sort of an emergency or end of life planning workshop that we're going to be hosting with Robin Pendariès, who volunteers with Cancer Support France. So we're going to be announcing all of these upcoming events. And if you're in New York or Boston, I am going to be at the French Library in Boston next Tuesday at 6 p.m. to present on moving to France, and at Cuckoo French in Soho in New York City on Wednesday the 19th. So if you have not yet signed up for any of those events, you can do so. They'll be in our email newsletter. And yeah, we look forward to many more tax events coming up because 'tis the season. So thanks for joining me, and we'll post the recording of the webinar and, of course, a link to the PUMa simulator if you would like to access that as well.
Bye bye.